Bill Ackman is a legendary investor, and for a great reason. Since 2004, he has averaged a return of 16.9% per year, significantly higher than the S&P's average return of 9.6% over the same time frame. His expertise led him to make billions from the 2008 recession and turn $27 million into $2.6 billion during the pandemic. Ackman successfully made billions on the last two market crashes and is now betting big on what he believes will return massive amounts of money. Even though he is not liked by everyone, Ackman's track record has shown that all retail investors should see what he has to say. This video will go in depth on his new bet on one of the largest market crashes in history. Bill Ackman utilizes two main strategies to achieve high returns. The first one is to use his influence to impact businesses that he is invested in, which is also known as activist investing. Ackman's second strategy is arguably more lucrative, which is short-term speculation. The second strategy is what we will focus on in this video. Bill Ackman is very intelligent with the ways he bets on short-term movements because he always looks for asymmetric risk. Investors usually believe that taking on higher risk leads to high reward, but that's simply not true. Hedge fund managers like Ackman look for asymmetric risk, which means low risk and high reward. Ackman recently found a bet with substantial asymmetric risk. Everyone knows that inflation is continuing to accelerate, despite the Fed previously touting inflation as transitory. The annual growth rate in consumer prices has accelerated from 1.2% in November 2020 to 6.8% in November 2021. That is obviously a drastic increase, and for a great reason. The Federal Reserve has been adamant about printing trillions of dollars into the economy with 0% interest rates and quantitative easing, which is when the Fed purchases bonds. The stock market has risen significantly in response to the Fed's actions, but this won't last forever. In late October, Bill Ackman gave a presentation to the Federal Reserve explaining why the Fed should taper immediately. Ackman's presentation exposed the inevitable market crash that will eventually result from a few impending factors. First of all, the government has injected $5.1 trillion of stimulus into the economy since the beginning of the pandemic. $5.1 trillion is 25% of the US GDP, which is unprecedented in its consequences. We can see the level of spending from the Federal Reserve from this graph of the Fed's total assets. The Fed is continuing to purchase hundreds of billions of dollars worth of bonds, which is temporarily saving the economy. These actions are delaying future economic problems rather than fixing them. We can see this from the Fed Chair Jerome Powell's response to inflation, which he sees running into next year. The stock market never crashes out of nowhere. There are always events that intensify to a point that triggers a market crash. The Fed's actions have left two options that both result in devastating outcomes. The first is to raise interest rates and stop quantitative easing for the sake of the economy. Doing this would almost certainly crash the stock market, but save the US dollar from accelerating inflation. The second option would be to not taper and keep interest rates at 0% to let inflation accelerate. In other words, the second option is to keep the money printer printing. This option would be even worse than the first one, because inflation would still crash the economy while simultaneously destroying the US dollar. Bill Ackman is advising the Fed to go with the first option, which is to taper immediately and begin raising rates. In essence, the market already crashed, but now the Fed just needs to choose the outcome that isn't as worse. Ackman elaborated on this by saying, "We are continuing to dance while the music is playing, and it is time to turn down the music and settle down." This was in reference to Margin Call, a movie that detailed a hypothetical scenario where the economy was going to crash.
What you're telling me is that the music is about to stop.
The economy has been booming, and Bill Ackman is continuing to dance while the Fed keeps interest rates at 0%. However, it is time for the Fed to turn off that music and let the economy correct. In preparation for this, Ackman is initiating a short position to hedge his portfolio. Ackman stated, "As we have previously disclosed, we have put our money where our mouth is in hedging our exposure to an upward move in rates, as we believe that a rise in rates could negatively impact our long-only equity portfolio. There are a few markets that investors can short to hedge their portfolios, but there is one particular market that Ackman is shorting. The market that I'm talking about is the bond market. The bond market has risen significantly over the past few decades, leading bond yields to decrease to historical lows. As some of you may know, an increase in bond prices decreases bond yields, and a decrease in bond prices increases bond yields. The two factors are inversely related, so shorting the bond market would be a bet that bond yields will go up. The 10-year US Treasury bond yield is currently at roughly 1.4%, which is significantly lower than the inflation rate. So the question is, Why would anyone ever purchase bonds when inflation will almost certainly be higher than 1.4%? Investing in such an asset would be equivalent to lighting your money on fire. Ray Dalio, Cathie Wood, and Warren Buffett have all stated that bonds are in a bubble, and I'm sure many others agree as well. Shorting the bond market is an asymmetric bet because bond yields can't get much lower from here. On the other hand, bond yields can easily increase substantially to account for the massively increasing inflation rate. This is the short trade that Michael Burry is doing, which I'm sure many of you know from the movie named The Big Short. Burry tweeted, "For what I know, I've never shorted any cryptocurrency. This is my third bubble and the biggest. I've learned a thing or two." 30-year treasuries on the other hand. Burry is implying that he is shorting the bond market, which can be done by outright short selling a bond ETF like TLT, which is the iShares 20+ year treasury bonds ETF. However, for high net worth investors like Michael Burry, he may be using a more complex derivative on bonds that is not available for retail investors like you and me. Bill Ackman is certainly doing so. Ackman is purchasing two different derivatives, credit default swaps and put swaptions, which are options contracts to swap bonds. There are two types of interest rates, a floating interest rate, which changes based on the bond market, and a fixed interest rate that stays the same no matter what. Swaptions are derivatives that are purchased from the perspective of the bond lender. Instead of obtaining an interest rate for purchasing a bond, owners of swaptions have to pay the interest rate to bond holders. A put swaption is a contract to be the bond lender and pay a fixed interest rate to the bond holder. In the events that interest rates increase, the owner of the put swaption would make profit off of the difference in interest rates. In this instance, the floating interest rate increased to 4%, but the owner of the put swaption has a contract to pay a fixed rate of 2%. Therefore, the put swaption owner would be profiting from the difference in interest rates, which is 2%. This difference would increase the value of the put swaption and therefore allow the swaption owner to make enormous sums of money with low amounts of capital. Ackman purchased put swaptions because he can profit immensely in the case that interest rates increase. Even if interest rates decrease or remain the same, he does not lose much money. The other derivative that Bill Ackman purchased is credit default swaps. A credit default swap is similar to buying insurance for a house. The owner of a credit default swap has to pay a small payment periodically. Let's say for the sake of this example that the payment is $500 per month. A credit default swap is insurance for the borrower's ability to pay monthly payments. In the event that the bond defaults, the banks would have to start paying the monthly payments on the bond, which would be much higher than the monthly payment of just $500 per month. For instance, let's say that amount is $10,000 per month. While this analogy isn't exactly the same, this would be similar to a house catching on fire on insurance, because the bank would now have to pay an amount as large as $500,000 to repair the house on a $500 monthly payment. Bill Ackman is using both put swaptions and credit default swaps to make billions if the bond market crashes. Ackman already successfully profited from this in the 2008 recession and the pandemic. Now, he is doing it once again, but with put swaptions as well.
Pre-financial crisis, we were concerned about what was going on in the credit markets. So we built a very large notional short position in credit by purchasing credit default swaps on the bond insurers, on Fannie Mae, Freddie Mac, on the banks. And as a result, S&P was down 52% in, I think, 2008. And I think our peak decline was 18%. It was just momentary. And we finished the year down only a few percent. And we were up 40% the next, driven by that hedging gain and the redeployment of those proceeds in buying stocks. And then last year, when we became quite concerned about the pandemic in February, we did the same thing. We thought the best way to express this concern and in a risk minimizing way is to, again, buy credit default swaps, put a very large notional position in the credit default swap market, and then spreads gap very widely as it became clear that this was going to be a pandemic. And then we reversed that position as our portfolio declined in value, our stocks went down, and our hedge became enormously valuable. So the hedge actually, on a mark-to-market basis, mitigated almost our entire mark-to-market loss. But more importantly, it gave us capital to invest, over $2 billion of capital to invest in a market that was down a large amount. And most recently, our biggest kind of black swan fear for the markets earlier this year, we became concerned about inflation. We thought inflation could lead to higher rates. We thought higher rates could lead to lower values in the equity markets. And we built, again, a very large notional position betting that rates would go higher. We did this using swaptions, which are sort of an option on an interest rate swap, which is a way to express that kind of bet. But the three things I mentioned they're small. The capital commitments are 1%, 1.5% of capital, numbers like this, but they can turn into very, very large numbers in the event that the sort of outlier event takes place.
I previously mentioned how the annual growth rate for consumer prices has increased from 1.2% to 6.8%, but that's not necessarily true. The rate that I was talking about was tied to the Consumer Price Index, or CPI in short form. The Consumer Price Index tracks a basket of goods that are weighed to create an average price for consumer goods. This sounds great in theory, but the data collection for housing prices is inaccurate in the index. Ackman believes that the owner's equivalent rent, or OER, is understanding inflation by relying on surveys. Using a more accurate tracker of rent, Ackman found out that the annual inflation growth rate should actually be 10.1% instead of 6.8%. Ackman tweeted, "Reported inflation is understated. Owner's equivalent rent relies on owner surveys to estimate inflation and housing costs. This is an extremely imprecise metric. The single-family rental market provides more accurate data." OER in today's reported core CPI was 3.5% year over year. It's certainly quite strange for the OER to be reporting a growth number for rent prices as low as 3.5%. This is obviously inaccurate and should be replaced with the single-family rent prices. Ackman elaborated by saying, "The largest owners of nationwide single-family rentals are reporting 17% year-over-year rent increases. OER is 30% of the core CPI calculation and 24% of the reported CPI. Using the more empirical measure in the calculation increases today's core CPI from 4.9% to 9%, and CPI from 6.8% to 10.1%. An inflation rate of 10.1% would obviously be concerning for the bond market. Bond investors would have a net inflation adjusted return of minus 8.7% per year. Some might say that this inflation is transitory, but Ackman thinks otherwise. He tweeted that housing inflation is unlikely to abate based on supply and demand trends. The inflation that households are actually experiencing is raging, and well in excess of reported government statistics. As if the situation can only get worse, the fiscal policy from Congress isn't helping at all. Joe Biden plans to pass an infrastructure bill and the Build Back Better bill that may be $2 to $3 trillion, which is around 10 to 15% of the entire US GDP. This will certainly lead inflation to continue to accelerate going forward. Other market concerns that Bill Ackman cited included the weakening China growth, emergence of new COVID variants, second-order impacts from supply chain constraints, geopolitical risk, and cybersecurity risk. These events could negatively impact the financial markets going forward, and only time will tell if they do. So there you have it, Bill Ackman's bet on one of the largest market crashes in history. Do you agree with Ackman's prediction? And if so, how are you preparing your portfolio? If you enjoyed this video, please hit the like button and subscribe, and I'll see you in the next one.